Well, let's bring in our roundtable. It is BlackRock's Kate Moore and Jim Bianco of Bianco Research. So, as Peter just said, as Travelin arrived, the expectations were so high. When you look at this mini drawdown, Kate, it's almost sort of like, I think it's sort of quite a relief, really, to see a little bit of the air come out of the tires.
Yeah, I have to say, it is a healthy bit of a drawdown. You know, there was a lot of angst in the last couple of weeks about how strong the performance of tech had been year to date. We know it's the best performing sector, up over 6%, and taking a little bit of air out makes sense. But let's be very clear. The earnings that came out last night were excellent earnings by any measure. They just maybe didn't meet the loftiest of lofty expectations. And we have a lot more tech earnings to get through this week. I think we're going to find that the sector is in extremely strong health and that there's a lot of opportunity to stay invested in tech throughout the course of 2024.
So, Jim, good morning. Good to see you. For you, these record highs in equity markets that we've seen cascade in pretty much every day last week, it's had a slightly different ramification for you on the corporate bond issuance. That's at record highs. What are the ramifications of high equity markets for you in the credit space?
Oh, I think that it is a loosening of financial conditions and the ability for companies to want to not only issue, but have it issued. And we've seen that with record corporate bonds. And I think it filters through to the economy as well and really makes the case that the Fed shouldn't be in any hurry to cut rates. I know they like to talk about being restrictive, but with record bond issuance, with an all-time high in the stock market, with economic data beating left and right, I'm having a hard time finding what exactly a 5 to 5.25 or 5.25 to 5.5 funds rate is restricting. So when you look at what's happening with equities and with corporate bonds, you have to kind of turn around and conclude that the economy's okay and there shouldn't be any hurry for them to cut rates.
Well, you bang on the money. It's not restricting anything because we have COVID hangover. We've got a structurally different work week and we've got a fundamentally different economy. Let's dig a little bit deeper into these tech earnings, because they have skewed the risk this morning. We're off to a shaky start. Alphabet, Microsoft, AMD, all dropping short of their lofty expectations. Mandeep Singh is Bloomberg Intelligence. He joins me now. The nuance, you say, is to understand perhaps the difference between Microsoft and Google in terms of AI. Just differentiate for me.
Yeah, I mean, look, in the case of Microsoft, we know AI contributed about $4 billion in revenue, and it was 6% of their Azure growth. So clearly, and it doubled from last quarter. So a lot of momentum for Microsoft, and not too, just with large language models or copilots. It's that entire stack. In fact, they gave a metric. The number of enterprise customers for Gen AI were around 51,000, and 1/3 were new customers. That tells you something. If Microsoft is signing up new customers, I mean, given their enterprise footprint, the Gen AI thing is real, and it's helping them expand their customer base. So Microsoft is becoming the most sticky product when you think about it from an enterprise perspective, both on the application side and the infrastructure side. In the case of Alphabet, I think the search is the real concern, how much it could get disrupted. But the cloud revenue did go up, and that's what Street wanted to see.
Do you think the advertising was that disappointing? I mean, on paper, it doesn't look huge, but we've written a monstrous amount about the disappointment there.
Yeah, look, they have the 90% plus share, and they keep growing, in double digits. The concern is, can they sustain that double-digit growth, or it's going to taper off to high single-digit? And I think based on the commentary yesterday from management, it sounded like they said the base is too high and search may not be growing double digits in the next 2-3 quarters, which is why I think you saw this kind of reaction.
Okay, it could be a long variable lag in the advertising and on the search side. Mandeep, thank you very much. Mandeep Singh there on the tech reporting. Let's take it back to BlackRock's Kate Moore. Kate, this is what you write. We entered 2024 with a pro-risk portfolio on the back of a resilient U.S. economy, supportive disinflation trends, and a core belief that peak rates are behind us. As such, we've been tactically adding to our portfolio risk, capitalizing on cheap vol and using derivatives. I mean, this must be one of the days that you relish. A little bit of a spike in vol, but things cheapen up. So where do you deploy to broaden your reach on days like this?
Yeah, so I would say there hasn't been a lot of trading in the last 2 days as everyone's been waiting for the FOMC decision, and of course the 40% of S&P 500 earnings that are getting released this week. So there's so much to digest, and positioning super aggressively ahead of that doesn't always make a lot of sense. That said, we have been, to my note, pro-risk and have had higher beta than normal because we've seen great opportunities across the equity market. I want to go back to a point that Jim made earlier, which is that higher real rates have not really been cramping the economy. And we've seen this across a wide variety of sectors. Company management teams have been telling us activity looks good, our prospects look strong, and even with these higher rates, we still see prospect for significant earnings growth in 2024 after earnings contraction in 2023. So it's kind of hard to step away from the market. That said, we have been using derivatives very aggressively. We see volatility in certain areas as being priced very low, and it's been a great opportunity for us to buy vol at those levels.
I'm curious, Jim, for you, when you see a lot of people have come on one after the other and talking about low vol, low MOV, low VIX, a prime opportunity to pick up protection. In that lowish volatility regime, how does that manifest itself for you?
Well, it does because of the stock market going up. There is an investor skew involved and it goes down. But I've always contrasted it with what you see in the bond market. And in the bond market, the volatility numbers are above average. And in the last month or so, they've been way above average. And you've seen a lot of volatility there and in the commodity markets, too. I mean, we've almost grown accustomed to, take one example, crude oil moving 2 or 3% a day. That, I'm old enough to remember when that was a big deal. Now that's Thursday or that's Wednesday in the crude oil market. So, yes, the vol numbers are very low in equities. But when you start drifting away from them and you start looking at fixed and you start looking at commodities, those vol numbers are much, much higher. And I think that represents an uncertainty about Fed policy, about global monetary policy, about the state of inflation. The stock market has decided that it's gone. Inflation is gone. The Fed needs to cut rates. Everything's okay. But I think when you look at commodities and fixed income, they're not so sure.
Jim, don't worry. You're not the only one that can remember moves in crude oil. In 1991, I think I got my first Bloomberg, and I understand what a crack spread was. Traded it very badly. The Band-Aid's about to come off in the Bank of Japan. What's that going to do to dislocate flows around the world in the bond market? Jim, briefly.
I think that it may be a big dislocation because the Bank of Japan or the Japanese are the largest treasury buyers in the world, even larger than China. If they allow their rates to go up and compete with the U.S., you're going to see money being diverted back to Japan.
Kate, you're a buyer of Japan. In what kind of scale? I've had various people that talk about it since I came to live here, but it's not a big thing. You are behind Japan in the medium term?
Yeah, look, and we've had a modest overweight to Japan, a modest overweight that we're looking to add to, and particularly to domestic-oriented stories. We're seeing, greater momentum in the Japanese equity market and in Japanese consumption, and we think it makes a good relative bet and a balance to what is also our highest conviction country weight, which is the U.S. Mm-hmm. The one thing I will kind of note here is that a lot is going to depend on the inflation trajectory. We have great hopes for a little bit of inflation in Japan and this rotation in terms of BOJ policy. But at the very heart of it, we see strong fundamentals for Japanese companies. And I think earnings, whether that's in Japan, in the U.S., or in pockets of Europe, are going to be what leads the equity market higher this year.
Okay, hold those thoughts. Kate Moore and Jim Bianco, my guests this morning on the panel. Let's take this morning are Jim Bianco and Kate Moore. Jim, I want to take it to you first of all. I mean, there's a fine line. There's a wonderful phrase the Brits use, which is, loose lips sinks ships. How does he thread the needle today to deliver neutrality and, I presume, optionality for March? Should March still be live at the end of this press conference tonight, Jim?
Well, March is live now. If you look at the latest probabilities from the market, it's essentially 50-50. And what he says will have a long way as to which way it goes. I think he preserves his optionality by stressing, the old saw that the Fed likes in data dependence. If the data continues to warrant the idea that inflation is moderating and the economy can see some kind of room for them to lower rates, they will. I might add, that 2 weeks ago, the probability that they were going to cut rates in March was 85%.
Yeah.
And now we're down to 50-50. And I think that represents that the data has been a little bit stronger than the Fed needs. So if that continues with that stronger data, then all of a sudden March might be pushed into May.
Kate, I ask this to many equity investors. The velocity of the equity rally, the ramp in the Nasdaq, the ramp in the technology side relative to value, has to a certain extent been predicated on rate cuts. How much will it interfere with your overall thesis if it's 3, 5 or 6 rate cuts? I know there is a differential between 150 basis points and 75 basis points, but materially from an equity investment point of view, how much difference will that make?
Yeah, it will make very little material difference, in my view, to the equity market direction over the course of the year. I mean, we're at a point where we're talking about when, not if, the Fed adjusts policy rates over the course of 2024. And most importantly, the leaders across technology and across these other sectors are not dependent on lower rates for performance. What we want to see is kind of a glide path of the economy where we have growth, but perhaps a modest deceleration. The consumer looks good. Demand for things like AI, software, and tools continues to stay robust. I mean, that's the best story for their earnings in the S&P 500. What I will say is, this is a very different market from balance sheet, from leverage, from dependence on debt than it had been in previous rate hiking and rate cutting cycles. So we need to acknowledge that there is not an easy comparison and acknowledge that the health of these companies, particularly in the tech sector, the return on invested capital, the free cash generation, are at levels they've never been before. So I don't want to sound like a wild bull here, but I think we need to be constructive. There's a fundamental reason, not just a rate cut reason, why these equities are outperforming. I think we're going to get fits and starts, periods of trading consolidation, and perhaps we're entering one of those right now. But we'll continue to make new highs throughout this year, and it pays to be risk on.
Yeah, I think for most of us, it's probably just that hesitancy and a sharp intake of breath at the speed with which we got here. We got to the end of 2024 targets for a lot of houses almost done and dusted with very little breath left on the upside. Jim, can I take it back to you? One of the best lines I've heard, and I've heard many, is from Claudia Sahm. Of course, she is the author of the Sahm Rouge. She said the Fed should just get out of the way. They've got a dual mandate. One is inflation, that's being behaved. And the second is full employment. And we're at it. Get out of the way, Fed. But can you be that bullish? And therefore, what does that mean for loading up on this mini handbrake turn in yields?
Yeah, I think that the risk of that idea that the Fed needs to get out of the way is the presumption that we've got inflation licked. I know that everybody says we've got inflation licked. They also said it last year. They said it 2 years ago within transitory. And it just continues to be the story that there isn't an inflation problem. Count me in the camp that thinks that there still is. Yes, we had transitory inflation. It got us to 9%. But once that smoke dissipated, I still think we're in a 3 to 4% inflation world. I think the last mile has already been run, to use that metaphor, and that we're probably near the lows of inflation. And that's going to be a problem for the Fed. Now, if that is, then this presumption, get out of the way, let's just cut rates, let's just declare victory, could look a lot like what we saw in the mid-'70s when the Fed did the same thing, and then you fostered a resurgence of inflation. So let's be sure that inflation is done and behind us. And I think that we're in a post-pandemic world and that the economy's changed enough that people are more in a spending mood, that if you give them more stimulus, you're going to see more inflation. And that's what my concern is.
By the way, I want to remind you, the world didn't stop at 5% rates in the 90s or 6%. The world did continue to run, and we bought houses and we did different things. So, Kate, let me bring it back to you. I want you to live in a world of where the last mile is tough and there's a stickiness at 3%. It's not that much of a challenge for you in 30 seconds.
Yeah, I don't think it's much of a challenge at all. And as I mentioned, companies have made significant changes to the way they approach debt, termed out their debt, and locked in very low rates. We know that for the S&P 500, the average effective debt rate is around 3.3, 3.4%. So I think we're in good shape. A 3% environment where we have moderate growth and consumer stays high and we have lots of reasons to be optimistic is a great environment. I'd rather be there than a 0% where we're concerned about recession.
Shape up and look large. Kate and Jim Bianco, my guests this morning. No fear in either of you coming up on the show. Your morning.